These results are yet one more confirmation that our strategy is on track and is delivering. A quick run-through of the four segments. Our soaps and detergent segment grew by 19% with a good mix of UVG and price growth. And as you can see in the chart, all of the segments and formats grew in double digits. We continue to drive category premiumization, and this, along with strong cost management, resulted in our segmental profits being ahead of top-line growth. Personal products has shown a healthy growth in a fairly challenging competitive environment. In the financial year, personal products grew at 13% with a broadly equal split of underlying volume growth and price. All of the three large categories, skin, hair, and oral care, grew in double digits, with the skin growth clearly showing a slowing trend in the latter half due to the reasons we already talked about. Our focus on market development in personal products continues. Segments of the future in personal products now contribute more than 1,000 crores turnover to the company. Segmental profit growth is slightly below top-line growth as we've invested in additional brand support to drive growth. Third category, beverages, has been a strong performance in the year with good volumes and an overall 13% top-line growth, which is pretty healthy and competitive. This growth has been broad-based across both tea and coffee, and we've continued to drive not just the core, but also the future segments. Profit growth has been quite strong despite an environment of firm costs, particularly in the latter part of the year. The last segment, packaged foods, has grown by 10%, a growth that has been led by the core. I talked earlier about Kisan Ketchup showing strong growth in March quarter. This is now the third consecutive year of double-digit growth in Kisan Ketchup. Nor growth has been led by soups, and having relaunched soupy noodles towards the end of last year, we now look forward to this continuing to build momentum. Growth in quality walls is a tale of two parts of the year, the first half being a very strong performance, and the second half clearly showing a slower level of growth impacted by the slowdown in the market. As we look at the P&L for the full financial year, it's a year with a turnover of 25,200 crores, an operating margin just shy of 15%, and a net profit growth of 41%. PAT-BEI, which is really the underlying profit growth, grew by 28%, the difference being some significant disposal of properties. Just to give you also a sense of another important dimension of performance, which is the cash generation, and really pleased to say that our operating cash, both from profits as well as from working capital movements, has stepped up by almost 1,000 crores between FY12 and FY13. So we continue to deliver strong generation of cash from operating profits as well as driving working capital for greater efficiency. In terms of dividend, you have seen the press release where the board has proposed a final dividend of 6 rupees per share. So the interim plus final dividend totals to 10 rupee 50 paisa, which is a 40% increase on financial year ending March 12. Including the special dividend, the total dividend translates to 18 rupee 50 paisa. Therefore, in summary, it's another year of competitive and profitable growth, a performance that is broad-based, led by good UVG, good improvement in operating margin, and as I said earlier, a reconfirmation that our strategy is on track and delivering. The cash delivery has also been strong at about 4,500 crores, which has enabled the company to declare a healthy dividend, including the special dividend of 8 rupees. As we look ahead, the positive outlook for FMCG categories from medium to long term is something that we would clearly reaffirm. We believe that with our strong portfolio of brands and our superior capabilities, we are well positioned to deliver to our strategic goals, which is consistent, competitive, profitable, and responsible growth. In the near term, however, we do see a concern around moderation in market growth rates, as well as the inflationary pressures on consumer wallets. In particular, this will impact discretionary categories, and it is our role to make sure that we remain competitive and give value to our consumers through this period. Over the future, as I said earlier, we remain committed to our strategy, and with that, I'd like to close this presentation and pass over to Nitin for his observations.
Thank you, Sridhar, and welcome to all of you who are on this call. You've just heard Sridhar talk about the performance in this quarter. Let me start by saying that I too believe that we've delivered another quarter of consistent, broad-based performance, particularly when you look at it in the context of the current business environment. We've grown competitively, delivered healthy volumes against the backdrop of a market which has seen some slowdown. We've also continued to grow our margins even after making significant investments behind our brands and our capabilities. Now, the current slowdown in the market, in my judgment, is partly on account of the weakening consumer sentiment due to the stubborn consumer price inflation, and partly on account of the modern trade channel, where growth rates have come off sharply due to the significant rationalization of stores and far fewer new store openings. In addition to this, the lower price growth component is also impacting the overall value growth in the market. The fact that there are these near-term headwinds is not new news, but it is a context that we need to be conscious of for the next few quarters. We believe this is a transient phase and does not alter our view of the fundamental drivers of consumer demand in an evolving India. We remain confident of the medium to long-term outlook for the FMCG business and also believe that we are well positioned as markets and opportunities evolve and hence remain committed to our strategy. You've heard me say this before and I'm going to repeat it, that we don't run this business from a quarter-to-quarter basis and hence I'm not particularly concerned on what would happen next quarter or so. What is important for us is to continue doing the things that will enable us to win with our consumers both today and tomorrow. Let me spend a few minutes on our personal products performance, an area which normally draws your attention. Our personal products growth during the quarter was 12%, in a market which, as Sridhar said, has shown significantly lower growth. This has been most pronounced in skincare, and consequently has had a significant impact on Fair & Lovely. Having said that, the good news is that Fair & Lovely continues to hold its share in the segment. As far as the rest of the skin portfolio is concerned, the sustained performance on Pond's is really encouraging. Pond's has now become a 1,000 crore brand this year, and it gives me confidence of the progress that we are making on building authority, on expertise, on the beauty business in which Pond's participates. I'm also particularly pleased with the performance of our hair and oral business, both of which have seen stepped-up performance. The growth in hair has been broad-based, driven both by activation as well as innovation. While Clinic Plus, Sunsilk and Dove have done well, Tresemme continues to gain ground, and as a matter of fact, within the first 6 months of its launch, is among the leading brands of conditioners in modern trade. A great example of how we can leverage the global Unilever scale to win locally. Dove is another addition this quarter to the 1,000 crore club and exemplifies how we've leveraged the equity of a brand by taking it across categories to build a winning portfolio. As far as oral is concerned, I'm heartened to see the progress that we've made. Our performance has improved over the last year with each passing quarter. Therefore, when I look at the totality of our PP business, I know we are making good progress to further strengthen our positions across the portfolio. And hence, although there are near-term concerns in market growth, given the relatively discretionary nature of the PP categories, let me reiterate that we see PP, or personal products, as a key focus area and will continue to invest behind this business as you will see reflected in our results. Coming now to the full year performance, of our results, I can see that it is another year where we've delivered consistent, competitive and profitable growth. The state of the business looks healthy and we continue to invest behind innovation and capability building while driving execution in the year even harder. With over 3,300 crores of incremental turnover added to our domestic business and a 7% UVG, a 16% USG and 80 basis points of operating margin or EBIT margin expansion in the last 12 months, I believe our strategy is well on track and delivering. In addition to this, we have made good progress on our sustainable living plan agenda. Looking forward, our priority therefore remains unchanged. We want to win in the marketplace and deliver growth which is consistent, competitive, profitable, and responsible. That's all from me.
Thanks, Nitin. Thanks, Sridhar. With this, we now move on to the question and answer session. May I remind you that this call is only for institutional investors and analysts, and therefore if anyone else from this call has a question, you might like to get in touch with us at Investor Relations. What I'd now like to do is to hand you back to Sauradeep, who will moderate the next section of questions. Over to you, Sauradeep.
Thank you so much, sir. With this, we are going to start with the Q&A interactive session. So I would request all the attendees and the participants, if you wish to ask any question, kindly press 0 and 1 on your telephone keypad and wait for your name to be read. I repeat, attendees, if you wish to ask any question, kindly press 0 and 1 on your telephone keypad and wait for your name to be announced. And the first question is from Mr. Avnish Roy from Edelweiss Capital. The line has been unmuted. You can go ahead and ask the questions, please.
Hi, sir. Congrats on the very good set of numbers. My first question is on the detergent business. In Q4, we have seen the promotional activity and the price cuts also, both by the competition and by Lever also increased markedly. So in the raw material side, we have not seen the commensurate cooling off. So does this really reflect that the competitive intensity has gone up? And if you could tell us the reasons behind that.
I think we've always maintained that this category has been competitive. At different times, the analysts have been of the view that it is reducing or not. We've always believed that the laundry category has been competitive with intensity both from local and regional players as well as global players in this marketplace. We don't see any change in that. We do see some differences that as when commodity costs start softening a bit, advertising and promotion intensity goes up. We are beginning to see that in the laundry category. You would recollect that a few quarters ago, when commodity costs were high in this space, we used to say that the advertising and promotion intensity in the soaps and detergent space has come down. We are seeing a reversal of that. Overall, it really means that players manage the totality of their P&L between different line items, and therefore I'm not very surprised when I'm seeing some of that going up. Contrary to what you said, that commodity costs haven't moved, I think commodity costs are a little softer than what they were a year ago, and therefore there is a benefit that we've got. Of course, the reduction in commodity costs is not the same as you would see in our soaps business, where palm oil is corrected far more sharply than you would see in the area of crude and the consequent impact on raw materials that we use in our business. As far as our competitiveness is concerned, our approach has not changed. We will do what it takes to make sure that our brands remain competitive, both in terms of product quality and in terms of being competitive price. Performance is generally good. There were some actions which were taken on wheel towards the end of last quarter, which we talked about. They are beginning to see results. We believe more can be done, and we are doing more of that in order to step up our performance at the lower end of the market, which can do with some improvement. At the middle and the top end of the market, our performance has been very good, and we hope to sustain that as we move forward.
So my second question is on the